Hello and welcome to Acumen Analysis, the show where we talk about economics, market conditions and politics and how that impacts you and your business. Welcome to this episode of Acumen Analysis, where today we are talking about
economic indicators and that you read about in the press and how they affect you and your business.
And we're starting off with GDP. And we've sort of talked about this a little bit in previous episodes, but let's kick it off with what does it mean? And what does it mean to us when it changes as individuals and businesses?
Okay, GDP is gross domestic product. It's an economic term. It measures the size of an economy. But if we scale it down to an individual, it's what is it you earn as an individual aggregated across every individual in the country. Now, it excludes things like benefits because that redistributes income. It's looking at profits if you're a business owner or a company, and it looks at your income if you're an employed.
So if we had, like, say, 5 people in a country, and they all earned 100k each, and there was no businesses, GDP would be 500k?
Yeah.
Oh, that's easy then. Okay, and then so say, for example, GDP goes up. What does that mean for me? Or what does that mean for
it means
that
the country is wealthier. It has more income at its disposal. Unfortunately, because it's an aggregated measure, it doesn't mean it's gone into people's pockets. But as a business owner, it's a good indicator. If the economy is doing well, it normally means that you can charge more or your prices are able to be, and therefore the bottom line should be better.
So as it's an aggregator of sort of salaries or what an individual's earning, not necessarily salaries, but income generally, and businesses, we could have a situation where, going back to our country of 5 people, we could have 5 people all on 100k each, but then we could also have a business on 100k of profit, which then doubles its profit from one year to the next, and GDP could go up, but the individuals could basically be earning the same.
And the question is, what would happen to that profit?
Yeah, will that then go into someone's pocket eventually and then...
Yeah, so if you imagine there was tax and the tax took that money out of that profit and then redistributed it to the individuals would be better off, but the total GDP would be the same. It's not dealing with how that income is distributed amongst its population. It's just looking at the total.
And when GDP is, the data's being collected for the statistic overall, is it pre or post-tax?
It's before taxes, how much you earn. It ignores the redistribution of income. So it's not interested in whether you tax it and then it's put into benefits. It's looking at the size of that economy.
So we could have a situation, going back to our example again, 5 people earning 100k each in one country over here with low tax, 5 people over here earning 100k each, with high tax, and GDP could be the same essentially.
Yes.
But these people have less money because they're on high tax. People with low tax have...
Whether you have more money or not depends on how that tax would be distributed. The reality is GDP doesn't look at that. It just looks at the total income of a country. So if that high tax country chooses to take that extra tax and give it back to its citizens, you'll end up in the same position as a low tax country taking its tax and giving it all back to its citizens.
That's quite a big if.
It's a very big if. Yeah, tax leakage is no.
But I think it's an interesting, because I think GDP is often touted by whichever government's in, as long as it's going up, that is, as a sort of, we're doing really well, look at GDP, but it doesn't necessarily mean that its citizens are celebrating in the streets.
Exactly. There's two aspects to this. One is the distribution of that income, as we talked about, and how that's improved you as an individual. The other aspect is inflation. Now, the growth figures for GDP normally adjust for inflation, but the nominal figures don't. So you have £100 of income today and it buys you, 100 apples. And in a year's time, the income you're generating is £105, but you can still only buy 100 apples. So you've actually got no increase in your wealth, and your income that you're generating is the exact same. You have £105, it buys you 100 apples, that's it. However, the politicians will say GDP has increased from 100 to 105, assuming a one-citizen country. But when we look at GDP growth, it will be adjusted back to zero because it's buying you the same value. That's what's called purchasing power parity. GDP growth is a real number, and by real we mean having stripped out inflation.
Okay, so when we're talking about the GDP of a country, it includes inflation, but when we're talking about the growth one year from the next, it strips inflation out so we can have the real...
What it highlights is you've got to be really clear in your definitions, because you can have a real definition of GDP and a real definition of GDP growth. You can have a nominal definition of growth and a nominal definition of GDP. So you've got to be really clear. Normally, GDP is an absolute number. It's not adjusted back to earlier prices, an absolute figure based on today's prices and what, the 105, even though they buys 100 apples, versus the growth figure, which is normally adjusted for inflation. We need to be clear on that. The key thing I think is this tells you how wealthy the average person can be, right? So you need to arguably move it in to make it easier. Look at GDP per capita. So the average amount of income per citizen. Now that's a bit misleading because the huge disparities in the size of population and workforces, etc. But it's an indicator in the same way GDP is. But it's important to know the direction of travel. And I often
about the trends.
That trend, if you're in an area that's got a lower GDP, you can feel much wealthier because your GDP's gone up. Your income has gone up relative to your peer group, even though there might be people in another part of the country who are far higher incomes than you. It should be measured on a relative basis to how you live your life. And I find there are two people that I like to speak to just generally ask, how are you getting on? Okay. When I go in a taxi, I want to ask them, how's business? Are you busier? If the taxi drivers are busy, people are spending discretionary money on taxis. You can always get the bus, you can always get a train, you could always walk. Why are you getting a taxi? Yes, there are always people that want to get a taxi, but the marginal person who's making that decision is doing so because they can afford to and they feel that confidence factor. The other one are lawyers. Lawyers tend to have transactional businesses. You ask them, what are they doing? They could be property lawyers. Well, they're only interested when property transactions are happening. People in the M&A, so the corporate law, are only happy where there's corporate transactions. They're busy then. So I think you ask both these segments of society how they're getting on. And if they're busy, then you know the economy is doing well. If they're not busy, then the economy is probably not doing well and you need to think about how to react. And if the economy is not doing well, you probably want to think twice before you splash money on speculative decisions. If the economy is doing really well, maybe you can take more of a risk.
The next thing we're on to is unemployment rate. And I think we all know what it means, or I think a lot of people would know that, if unemployment's up at 5%, whatever it is, that's the number of adults looking for jobs or the jobs outside of work.
It's those people that are looking for work and not got work, as opposed to the neat definition, which is not in education, not in employment. These are the unemployment is only those people who are seeking employment. And it's a good measure as to, again, where the economy is. So last podcast we talked about GDP and a measure of how well the economy is doing as a whole. Unemployment is the exact same. It just looks at it from the other perspective. If there's a high number of people unemployed, then there's a concern that the economy hasn't got work for those people. And therefore, the economy is not as strong as people would like to see. If we're finding you've got low unemployment, then everyone's getting jobs, or a lot of people are getting jobs, higher number than would be expected. And that means wage growth. Again, you have to react to that. People are fighting for, employers are fighting for employees versus high unemployment, and employees are fighting for the few jobs.
So, the takeaway that I'm getting from that is, for an individual, if the rate is up, then there's that many more people you're fighting against for your jobs. So,
compromise on, you'll have a longer commute, you'll take less pay.
All the above.
You'll maybe do a job that's lower than what you think your skill base should be because you need to get that job.
For a business, is there some positives there? Are you in a stronger position from a negotiating perspective?
I tend to think you need to pick the right person for the role. But if you are saying you've got two people who are identical, how do you differentiate between them? And I don't mean go and get another interview, get a second opinion. When you've done all your checks, you literally don't care whether you employ person one or person two. Then the terms that you offer one of those people might be the differentiating factor. Might be less pay, might be more hours. Those sort of things that sometimes are negotiated by employees will now be to the employer's benefit.
Yeah. I think there's not a huge amount to go into that one. It's a pretty straightforward one. Let's talk about inflation rate. And I think for this, largely we're talking about the cost of things going up relative to yesterday.
So to me, inflation comes from two perspectives. You've got the cost of goods. What I would buy my Apple at today, it will cost more tomorrow.
Yeah.
That difference is the same apple, same shop, same thing I'm buying, it costs more. The other way of looking at it is, what does the greengrocer say? Well, the greengrocer doesn't say the cost of his apples. He's saying, well, I'm selling an apple for this and I'm selling it for more tomorrow. So inflation can both be an impact on the cost, but also on your income.
Yeah, absolutely right. And I think the one that people get very emotional about is Freddos. I don't know if you've ever seen the Freddo analogy, where people are in absolute despair about how much a Freddo costs, but almost also how much chocolate they get in their Freddo. And this is a really good example of inflation.
Well, I remember from you're slightly younger than me. So mine, it was the Polo Mints. Yeah. They were a certain size, and the size has shrunk. Polo, which only used to cost 10p, those packet of Polos, shrunk in size and now doesn't even cost 10p. And that is driven by not necessarily corporate greed. There's not just the owners of Polo Mints or Freddos. It's the fact that the costs going into that are higher. And that's the people who are working are now paid more. It's not just about minimum wage increases from a couple of weeks ago. We're talking in terms of the Polos, over decades, people are earning more than they used to. Cost of living effectively is higher, but people should be earning more. So both those things are feeding into the cost of production.
So inflation, I think it's a bit of a dirty word sometimes. Is it actually a bad thing, or is it only a bad thing in certain situations?
Okay, so if you have an economy where it's got negative inflation, it tends to be terrible because people will choose not to spend their money because it's cheaper tomorrow. I won't buy my Freddo today, I'll buy it tomorrow. So you end up with a disaster for the economy. So you don't want a negative figure. So you think, well, should I have zero? Well, zero means nothing changes. And you normally want to, in order for capitalism to function well, you need to have opportunities for change and growth and speculation. So you normally want a little bit of positive inflation. That's why the central banks typically are targeting between 2 and 2.5% as a sort of indicator of what annual inflation should be.
Say, for example, inflation's up at 20%. What kind of disaster does that give us?
Well, if you go back to the 1930s and 1980s and 1920s, this is the post-First World War in Germany. They had what's called hyperinflation. People would be getting wheelbarrows to the shops to buy their loaf of bread. The paper was worthless. People would rather have a loaf of bread, even though it's a perishable good, than the bag of money. People couldn't get rid of the money quick enough because it's just not worth anything. Money needs to be a store of value. You need to be able to hold on to it and make a sensible decision as to when you use it. And if it's becoming worthless tomorrow, you've got to spend it today. So suddenly what that does is mean everyone's buying a loaf of bread today. Prices of bread go up hugely, but there isn't anything left for tomorrow. Only the baker's got the money, and he doesn't want it. So he spends it, but by the evening he's spent it, whether it's down the pub or wherever it is. And what you're seeing is just wastage of money. So you need to have something that enables you to plan. Inflation rates of 20% mean that restaurants, for example, are reprinting the menus all the time. Now, in a digital age, that's probably just a bit of a labour effort. But in the traditional method, you're going off to a printers, printing those menus, and then guess what? Next week, they're out of date again. Because it's not just what you charge your customers, remember, it's also what your suppliers charge you. And if they print their new price list on a Wednesday, and on Tuesday you've just produced your new price list, you're out of date within a day.
I think where this has become the dirtiest word of all is when it's in relation to interest rates, which is our next one to unpack. But I think it'd be interesting to just talk about how inflation, when it's high, changes the value of future payments to a bank, for example, doesn't it?
If inflation is high, there's a worry that you're going to get hyperinflation because everyone says, oh my gosh, I'm better buying everything today than I am buying it tomorrow. And then everybody makes those decisions and prices go through the roof for goods today. So how does the government deal with that? Or in the UK, it would be the central bank. How, because it's not a political decision, how would they deal with that? Well, you use interest rates as an interest rate to change the value of money. If I sit there and give you more interest, then it's of more value for you to hold your money today and not spend it. So if you've got your money in your bank account, you've got a choice of buying a loaf of bread or keeping it in your bank and earning interest for a day. What are you going to do? Well, if you were planning to buy that loaf of bread, then at some point with higher interest rate, you may change that decision. So the whole point of interest rates is to manage that demand of the desire to spend money. So higher interest rates mean you normally keep benefits savers, so you would tend to spend less. So it reduces the expenditure pattern. And it's the corollary is true. So if you're not spending money, because you're holding on to it, better to reduce interest rates to encourage you to say, let's get rid of it because I'm not earning as what I used to earn by having it in my pocket.
Is there an element of, say, a bank gives out a 100k loan, and with inflation being particularly high, they know that the value of that capital sum is going to be, worth less money?
It's all part of the same thing.
Yeah.
You buy let's forget the Apple scenario and let's look at something that's got sustainable value. You've got this chair that I'm sitting on today is valued at say £100. In a year's time, that would be £100 plus whatever the impact is of that cost of money, a time value of money. So inflation was 10%, £100 would go to 110, assuming no sort of demand preferences changed. Interest rates will sit there and help guide that. If high interest rates, it would maybe mean that the expectation of inflation being 10% might only be 5%. So now the price of chairs is only £105. So the two are related. They
go hand in hand.
Yeah, they go hand in hand.
So let's talk about interest rates then. Obviously, we've seen that change an awful lot, especially in the current environment, UK a lot. And you've said it's often used as a mechanism for controlling the value of money and things like that. Is it good to have high interest or low interest? I think obviously depending on which side of the lender you're on.
Well, if you're a saver, you want high interest rates because you earn more for it. If you're a borrower, you want low interest rate because you pay less interest. So it depends. And for every saver, there's a borrower. For every borrower, there's a saver. So the economic wealth of a country and this income that's generated is driven by what's called a circular flow of money. How much money is it and how quickly it cycles round.
Yeah.
And interest rates are a crude measure of trying to change those parameters.
So let's break that down. So you're saying people who are trying to save are possibly better off when interest rates are at a high. So we're talking about potentially people who are about to retire, who are sort of saving onto their pennies for that stretch of life where they're not going out and earning it.
Yep.
They're whittling down a pot of money they've saved up. And then for people who are in the ramp up to retiring, they are also saving all the way down to, I don't know, let's say, because that's when people start thinking about their pension, although they should do it a lot earlier.
Well, should do it a lot earlier.
And then people at the beginning of their lives, when they're sort of having the biggest mortgages perhaps that they often would have with young kids, young family, whatever, that's when interest rates really hurt.
Yeah, so if you look at, so the interest rate's been pretty low since about 2008, when there was the various banking crises. What you've seen is low interest rates, governments coming in to rescue the markets. At one point we can talk about what that means, but the interest rates are low to encourage people to spend, to keep the economy going by buying goods and services in their economy. COVID was the exact same. People were petrified of the future, so interest rates were plummeted down to low at the cost of the Bank of England, a huge cost, but it was there to encourage people to carry on spending money to protect the economy, so the businesses stayed afloat. Now you roll that back, all that low interest rate, which was artificial in the COVID days, has to be repaid. Yeah. And how do you repay that? Well, I've borrowed more money, there's higher risk now in those borrowings, interest rates have gone up. Interest rates are a measure of risk and time. If interest rates are 10%, and I've lent you £100, that's £110 you'd have to pay back in a year's time. But what is that doing? Well, one, it's saying in a year's time, so it's putting a time parameter on it, and one is it's assessing your ability to pay. Now, the governments are generally considered, certainly the large Western democracies, are generally considered pretty robust at their ability to pay. So almost zero risk, as zero risk as you could possibly get, perhaps. So that's the low risk end versus a consumer on a payday loan borrowing money on a Wednesday when he gets paid on a Friday. Rather than waiting those 2 days, he needs his money. They tend to be the higher rates of, it's just a reflection of risk.
So government cares as well because they've got government debt. Obviously, they want that to be as cheap as possible, but they know obviously that interest rates also impact spending power. So it's a balancing act, basically.
Well, the UK's got a large level of borrowings, and if it can cope with those borrowings, it's not a problem. It's a credit risk question. Will lenders lend to the UK to buy its bonds at a sensible price? Or do they see the perceived risk as quite high? In which case they won't lend, and ultimately that means the government's going to run out of money and we'll have to make drastic decisions to cut expenditure. So whatever we think of the bond market as being a good or bad thing, the reality is it's a collective view of world money, because anyone can buy UK bonds. It's not restricted to just people from the UK. In fact, the UK typically doesn't buy UK bonds. So anyone in the world can buy them. So you've got world's view of the UK economy. And if interest rates go up, it doesn't necessarily mean the UK is more risky. What it means is it's more risky relative to every other country because they've got choices elsewhere.
Yeah, fair enough. Which actually isn't completely unrelated to economic confidence, which is our next point. Because obviously, if people have high degree of confidence in one country over another, that impacts their ability to pay, especially on government bonds.
Yeah. So it's often the word used is government bond yields or bond yields. So the more confident you are that you will get your money back, the more you'll be willing to pay for that bond. And if you pay more for that bond, the yield will drop. And the yield drops because when a bond traditionally was a piece of paper that said, I will pay you 5% of the face value of this bond. Let's say it was £1,000. I'll pay you £50 a year till it's repaid. Now, if somebody then says, I'll buy you that piece of paper, which has got a face value of £1,000 and pays you £50 a year for £1,100, then the yield has dropped. So the price goes up, yield goes dropped. So who would pay more than the face value for something? Well, someone who's got the confidence that it's worth more. So at the time that that piece of paper was created, it would have been created at market prices. And then market prices, market risk appetites change all the time. So governments have to be alive to what's going on in the markets, whether they like it or not. So you've got the face value of these bonds being issued as a measure of the confidence of investors in the UK economy.
And you gave that example of someone else being willing to pay more, which obviously means they're confident.
Absolutely.
Yeah.
Now, the indicators are you get various surveys that are done. So one's the market. What does the market think bonds are worth? Well, they've got their own data. They're looking at other countries. But how does it affect you as a business owner? Unless you're buying and selling or you've borrowed, etc., you're not bothered about bond rates. You're not buying bonds. You're not selling bonds. You're not paying interest that affects, you don't see the difference to the interest rate. So what does it mean? What's confidence mean to you? Well, there are various surveys being done to assess whether the country is generally more positive or more negative. Sentiments. The general view is if the sentiment is 50%, I am not confident or unconfident based on the previous month. If you're over 50, I am more confident. And that normally means growth, which then drives impacts on prices. So you have to be aware that growth will mean higher prices to buy, presumably higher prices to sell. And if the consumer confidence index, as it's often called, but there are other producer confidence, etc., other indices are less than 50, then you're looking at contraction. We don't think long-term the outlook is positive.
And there's no sort of, except for these surveys and the above 50% or whatever, there's not like a specific metric for this.
There's not a metric. As I said to you, I think last time I asked taxi drivers and solicitors what their views are to try and get a snapshot before the figures are published, because they're published in arrears. And business sentiment is an important aspect. It's not the only aspect. Many people will know straight away how their business is going. If they're a manufacturing business, if the suppliers are starting to charge more money, there's a reason for that. Why is that? Does that mean there's a problem with supply in that area? In which case you've got to think about whether you're buying from the right people. Is it there's a sentiment question that the people are concerned about things? Try and understand the impacts to you with all the data that's around. But long term, you've got to make your business decisions with all that information, and sentiment is an important part of it.
And if we need to start getting some data off loads of cab drivers and taxi drivers and solicitors, like you say, ourselves, so that we can start telling our viewers what the sort of sentiment is of the market. That'd be interesting.
That would be interesting.
Okay, so I think we've tackled that one. Budget deficit. It's often quite confusing, I think, for the public to know the difference between the deficit and the debt that the country has and the relationship between the two. Both terms get kind of banded around.
I think it's abused, how they use the system. It's an economic term, so it's aggregating everything together. But if you're a mortgage, you've got your own home and you've borrowed a mortgage. Let's just look at that as the example. So you've got a mortgage, that mortgage outstanding, that amount of borrowings you've got is the government's debt. Okay. Yep. Your income is the budget deficit or surplus, how much money you've got to service that debt. And if you earn a certain amount of money but spend more money on goods and taxes and services, etc., such that you don't have any money, such that you can't afford to pay your mortgage and you have to borrow more, then you are in budget deficit. So the deficit is the movement, normally annual. So the annual budget deficit is the annual amount of money that you have to service your debt, which is the principal and the amount of total outstanding. Now the UK's figures as a country, this is, I should say, as a state rather than as aggregate across all the individuals, is about 100% of our income is the debt, total debt amount. So that's like saying, I earn, let's say, £50,000 and I've got a mortgage of 50,000. The problem the UK currently has is I've got my mortgage of 50,000, but actually I'm not generating enough to cover it. I'm in deficit.
Debt's actually going up.
So the debt next year I'll have to borrow another £5, so it's not 50,000, it's 55,000. It's the debt. And that long term isn't sustainable. No individual would expect to be able to borrow more permanently. There has to be a day of reckoning.
Because I've never really heard, what I've heard a lot in the past is politicians saying we need to sort out the deficit, and government's gone by and things like that. And what they mean is bringing our sort of income and expenditure in line with each other. So from one year to the next, our debt isn't necessarily going up. But what seems to be the case, or at least for many years from what I understand, is that we've had a deficit ongoing for ages and ages and ages.
2001.
Yeah. So what I don't understand, and I'm not the economist in the room, you are. What I don't understand is how countries can sort of continue to do that forever and a day with no...
If you will, I mean, America's not had a surplus since the start of the Reagan era. So 1980 or 1981, but it is a reserve currency. You can continue to run a deficit, whether that's as an individual or as a country, if people will continue to lend you money. But as I said, a day of reckoning will come when you cannot borrow money anymore, or the interest rate that is applied to get that interest borrowing is so high that you can't take it. That's the challenge of this. There are two ways of resolving that. One is to cut your expenditure so that you now have a surplus.
Yeah.
Or you have to grow the economy so that your tax revenues, or you tax more, you get more income. Now, your two ways of getting more tax, just increase the rate. And, you know, we've all heard of the Laffer curve in recent days. So long as you're not beyond that Laffer point, you'll be able to raise more revenue. The other method is to grow the economy. So now the pie that you're trying to take your tax from is just that much bigger, which is why recent governments have gone on and on and on about growth. Stimulating growth avoids the really hard questions of increasing the tax rates or just taxing people more.
And the US has like an all-time high of several multiples of their GDP, don't they?
Well, sorry, America will be as an all-time high because it's not balancing its books. Yeah. So every year it's borrowing more money. And it's interesting, America has a special system where the budget has to be approved and it's across the House, and very often the House refuses to approve it and they go into sort of a lockdown, and state employees are told to go home and not get paid because they haven't approved all that expenditure. And that's a method of reining in expenditure, and then the political deal is done, and typically there's still some sort of budget deficit and America carries on. But America can continue because it's the reserve currency of the world. When there is risk and people are worried, whether that's times of war or just economic concerns, people say my money needs to be parked in a safe haven.
Yeah.
So you've seen golden years, the Swiss franc and the American dollar. So people go into the American dollar as a safe haven. That means in times of risk, America is still able to issue bonds.
Yeah, I mean, if people can remember back to when Zimbabwe had hyperinflation, they tried to stop using Zimbabwean dollars and tried to start using USD on the ground to buy their stuff. Yeah. Then it became a bit of a contentious thing where the Zimbabwean government were trying to stop people using dollars and all this stuff. Absolutely. USD being a safe haven. Something that's not on the list but should be on the list is quantitative easing. That's a really interesting one, and I think it's super contentious when people understand what it does. But it does impact the value of money, doesn't it?
Yeah, so quantitative easing is about saying how much money there is in an economy and available to lend. Banks have an ability to create money within reason. They're regulated to stop them just creating whatever. So the banks are lending money based on appetite to risk and looking at how much money they've got available to lend in their own balance sheet so they get the best bang for their buck, effectively. The quantitative easing says, well, you've invested all this money in the bond markets. That's what banks have done to earn the interest, which then allows them to lend money out. So what quantitative easing does is the banks buy from the banks these bonds back. So the UK bonds are bought by the Bank of England for cash at normally a fairly good price. That puts cash into these banks. Then say, what do I do with it? Oh, I'm going to lend it because I don't get a lot of money, a lot of interest, so I'm going to lend that money out. So it stimulates the economy by lending more money out from the banks. There's nothing wrong with that, but it can't be sustainable forever because first, there's only a finite number of bonds that the Bank of England can buy, but you're also having it's an artificial arrangement because the Bank of England is interfering in the market pricing by buying these bonds, so it's overpaying. That's how it's trying to stimulate the economy. If it didn't need to stimulate lending, it wouldn't do so. And all the time, the bank's announcing this is the base rate now. This is our new interest rate. What it's actually doing is saying, we will use our balance sheet as the big Bank of England, the big boy in this banking system, and we will buy and sell in order to get to the interest rate we want it to be. So the traders will tell you, even though you've got an interest rate announced of, say, 5%, they won't necessarily get to exactly 5. They might stop at around 5.1 or 4.9. Depends how keen they are to get to that rate. And that's, like almost how strong-willed they are to achieve it versus a sort of weak-willed to get there. The traders will be looking at the nuances of how they actually implement the policies. But for the man in the street and the business owner, generally speaking, you're not traders. That rate is a rate that's pretty good to go on. And with quantitative easing, the Bank of England is interfering more in the market to buy bonds. And when we do the opposite of quantitative, we try and unwind quantitative, we're selling these bonds back into the market to contract the economy, which of course means there's less money going round. That creates inflation.
So my understanding is that the buying of the bonds happens from creating more money, or people often say printing more money.
Well, what it's doing is it's putting more money in the banks. It buys it frees up the bank's balance sheet, effectively says, there's the money. It doesn't physically give the bank money, it's freed up the balance sheet to allow them to lend.
Doesn't that also have sort of an inflationary devaluation of currency as well? Impact?
Quantitative easing, well, it's relative to what the other countries are doing. You're interfering to achieve a certain interest rate. You're keeping interest rates a bit high.
I thought it had a direct impact on inflation.
So quantitative easing, a common topic because of what's going on over the last 10 years or so. And it's being unwound in most countries now. But quantitative easing is a government stepping in to interfere in the money markets to boost the economy. But it's doing it at an artificial basis, which needs to be paid back. So when you start taking that money out of the system, you're creating inflation.
Yeah, absolutely. And we've talked a lot about bonds. I think we've explained it at a high level, and at some point we'll do a whole debt terminology sort of episode. But if we could go into sort of bond yields for a sec, I know we've touched on it, and bond default rates. I think that would be helpful.
Bond yields are a measure of interest return on a given asset. Now that asset has a risk attached to it and is a time of when you get paid. So bond yields are a measure of time and risk. So typically you measure these price of what's called a risk-free asset. Technically there's no such thing as a risk-free asset, but government institutions are often considered as close to it. So AAA, whatever those particular countries are, not the UK anymore, but those AAA assets are risk-free. You have a little bit of country risk, maybe if you get to the UK level. And then you're going to have specific risk, which is looking at the individual entity that issues the bond. It doesn't have to be countries that issue bonds. It can be companies. Large companies quite often go into the bond market to issue bonds. The big things in America that you see is bond programs, where mortgages are often pooled together and then sold as a package to the bond market.
And that's the packages we saw kind of crash the banking sector, that where we had these sort of loan packages which were all marked down as AAA rated or whatever, where they actually like the grubbiest loans on the market.
What the philosophy behind that was that if you take one individual loan to a person who's got a very bad credit rating, the chance of you getting paid is not so good. But if you take 1 million of those people that aren't such good rating, what's the chance you get half your money back? Reasonable, right? So that was the concept behind it. So if you package all these loans up and say, what's the good chance you're going to get half of it paid back? Okay, someone will lend you that amount of money. Some bond will be issued for that. And what about the other half? Well, we'll issue a bond at a slightly higher rate for the next tranche of it. And what about the last bit? You're going to get all your money back. No one's going to buy that bond. So the people who initially lent the money, those banks, are left holding that money. And when you had the crash, what happened is there was a bigger slice of money being held by those banks because nobody wanted to buy them because their perceived risk was too high.
My understanding was that they were actually all being rated much higher in general.
Yeah, so there was a ratings problem. The people said that if you pool a whole bunch of bad assets, you turn them put a whole bunch of bad apples in a pot, lo and behold, they turn into a good apple.
And the ratings is directly in relation to the bond default rates.
Yes, so the rating is a measure. It's not a theoretical number, it's an opinion as to whether the bond that's issued, so it's not about the underlying assets, the bond that's issued can meet its obligations as it falls due.
It's a bit like a rating you might get from Moody's.
That's exactly what it is. It's a rating from Moody's, S&P, etc. It's not an assessment as to say it is worth this. It's an assessment, am I likely to get paid back as scheduled into that bond.
And often be represented as a
grading. But those gradings can relate into default rates.
Yeah.
So that's.
So you might get like a AAA rating, for example.
It means you're expected to get your money back.
AAA is about it doesn't get less than AAA. And so you'll have like a 99%.
I think you've got to be careful reading absolute numbers into it, because the Moody's officials say we don't do that.
No.
So they're saying that, it's more like the language they use and the words they use it. But there's no doubt that a AAA rated bond is much better rated than a single C rated bond.
Yeah.
In terms of probability of default is much lower in AAA than it is on C, and you get something called investment grade. So many pension schemes are only allowed to invest in investment grade assets.
Which is what, triple B?
Triple B plus, yeah.
Plus.
Well, those sort of depends to how you define it, but yeah.
An acceptable amount of risk while still getting a good return.
And that doesn't mean that assets that are below that quality, bonds below that, aren't reasonable investment. It just comes with a much higher degree of risk. So you need to get a higher return.
And I suppose what is deemed investment worthy is really just down to you and your risk profile, who you are, and what you're willing to risk for the return. Brilliant. I think that's all of the list we had for this short episode, and hopefully that was helpful. But join us next time when we're going to actually talk about debt and all the terminology in debt, of which there are quite a few. And thankfully, Stuart used to work in structured finance in EY and used to help structure debt. So that'll be a good one. See you next time.